Well, you find me in Arizona in the deserts with a beautiful view behind me. And I want to share something special with you. So in a couple of weeks, I'm going to cross my 10 years in the markets, 10 years trading. And what a ride it's been. And I always thought when I started in 2015 that my first 2 years, 3 years are going to be where I learn the most, because I'm learning everything. I'm learning strategies, I'm learning psychology. And then as you get older into your 5, 6, 7 year in your career, you kind of plateau, get comfortable. You've got a strategy now, you've got a working edge, and you keep seeing it through. And that's not been the case. In fact, I think this year, 2025, is where I've learned the most, being, after 10 years of starting trading. And a big part of that is because I'm very blessed to be traveling the world with this show that I have, Titans of Tomorrow. I started it 2 years ago, a podcast where I'm speaking to some of the best traders in the world. And this trip, I've done 5 states across the US, and I've spoken to some of the brightest minds in the trading industry in history, literally. Just yesterday, I spoke to a legend in the game. His name is Larry Williams. You probably are all familiar with him. He's the famous man that has got the all-time world record for the World Trading Championship. This year, the winners of the World Trading Championship got like 200% in the entire year. He did 11,000% in a single year. No one has come close to his record. He's an urban legend. I had the honor of speaking to him yesterday. And he's someone, when I first started the show, I wrote down my dream guests, and he was one of them. In fact, on this trip also here in Arizona, I spoke to Tom Basso. Tom Basso managed a fund of $700 million. He's well in his 70s. Larry Williams is well in his 80s. And Tom Basso, he's a market wizard. He was known as Mr. Serenity. Not only does he have a huge trading credentials, but he's also known as the stoic trader. Even just a few days ago, in New York, I spoke to Jason Shapiro. Jason Shapiro is, once again, a market wizard, has a 30-year track record managing $200 million. Anyway, the point goes that I've spoken to a lot of people across these 5 states in the US and London. I just did, spoken to hedge fund managers, bank traders. It's been wicked, and I've learned so much because I was also naive to a lot of things up until this year, which is crazy because I'm 10 years into trading. Something that I was very naive to is this idea that every strategy works. Now, every strategy works, I feel like, is a big cope, because a lot of people say that every strategy works because they keep believing for what I call liquidity. If I think of a broken clock. If a broken clock is stuck at 6, that means it's going to be correct twice a day, 6 a.m. and 6 p.m. But for the rest of the day, it's wrong. But the fact that it's broken doesn't mean it's a working strategy, it just happens to be stuck at 6. And a lot of strategies are like this, where I think head and shoulder traders, pattern traders, Fibonacci traders, all of these things are like the broken clock. They work sometimes. And I've been firm in that belief because I've seen so many traders struggle. I've seen 90% of the industry fails and 90% of traders trade the same way. So it got me thinking, well, yeah, every strategy is destined to fail. You have to really carve out your edge. You have to find these market inefficiencies. You have to find an arbitrage, and you really have to work towards an edge. And this year, when I've spoken to dozens of phenomenal traders with phenomenal track records, I've come to realize it's true. However, you can make many strategies work. It's not that every strategy works sometimes. It's that some strategies take a lot for it to work, and therefore you have to really earn your stripes. For example, when I speak to someone like a Tom Basso who has 50 years of trading experience, he trades very simple technicals. He'll take a range, he'll take the range high and the range low, and if it goes below that range, he'll sell. If it goes above that range, he'll buy. No break retest, no EMAs, just literally buy at the high, sell at the low. And I was blown away. And when I went to the New York Stock Exchange, and I was literally inside the stock exchange, had the unique privilege to film inside the stock exchange, having to get special clearance for our cameras, I spoke to traders there, and they said the same thing. We use very simple RSI, MACD, support and resistance. But why do these things work when for majority of traders it fails? It's because they add a level of fundamentals. They add a level of another analysis that we do not do. Which means what I'm trying to say here is that every strategy works. It just takes a lot for it to work out. Something that I want to focus on today and share with you guys is big takeaways from this tour that I've done for the last month, traveling the world. There's a lot of takeaways and some phenomenal episodes, and I've done literally tens of hours of trading conversations in the last 3-4 weeks. Some big takeaways. Again, after 2 years, 100 plus episodes, I've filmed some of the best episodes I've ever done, the most notable names with the most value-packed, dense information in the last 3 weeks. So I feel like I'm a wealth of knowledge right now. I'm just eager to get it out. Now, a few names that I really want to reference for my biggest takeaways of 2025, my 10th year in trading. Number one is going to be from Rishi. He's a quant trader, and I've never spoken to a quant trader. And what a way to kick off my quant learning journey, by speaking to not only someone that has a hedge fund, he's a well-qualified quant trader, but in fact he is an author of a quant book that other hedge funds utilize, or new quant traders read his book and are given his book from professors. He's a wealth of knowledge, and a few things that I learned from him: Jason Shapiro, who is the market wizard who managed 200 million, 30-year track record, and even Larry Williams just yesterday, 11,000% in a year and a 50+ year trading career. There's a few things in common here. Number one is, don't do what the masses do. This is a philosophy I've had with life. In fact, if I bring religion into it, whenever the Quran, I'm a Muslim, whenever the Quran brings in the masses, it's always done in a negative connotation. When God is speaking about the masses, it's always from a negative lens, because the masses are usually misguided, hedonistic, following their desires, not pushing hard, not disciplined. Like, that's the natural human state if you don't get yourself out of it. And the same applies for avenues in life that I've spoken about. Like, I'm a dentist. I went 6 years at university, and I was a conformist initially because I had a path put in front of me. And then as I navigated through life, I realized that time for money doesn't work, and I need to take a non-traditional path. And I took the non-conformist path, and that led me to being a business owner, led me to being a trader, led me to being an entrepreneur, led me to being a podcaster, traveling the world. And everything that I do, a lot of people say, well, why do you do that? Why are you doing X, Y, Z? And probably you the same. Back in the day when I was at university, my friends would say, why are you not coming out with us? Why are you doing X, Y, Z? Why are you still in your room? Exam season is over. Why are you still locked away at your desk? Now it's going to be, when I speak to certain guests, they're like, why are you traveling the world? We could have done this podcast on Zoom. I'm like, yeah, but I want to meet, I want to travel, I want to, have that human interaction, and I want to make better value production. Always take the non-conformist path. Not only in life, not only in religion, that's how God kind of speaks about the masses, but also here I want to speak about in trading. These three references that I've given, every single one of their strategies was a non-conformist strategy going against the masses. What this looks like is Jason Shapiro. His strategy is, he calls it a crowded market. Now this was very interesting to me, because when I spoke to most traders that use the COT reports, most fundamental traders, most futures traders, swing traders, they all swear by the COT reports, the commitment of trader reports. For context, if you don't know, this report is it's a publishing of all of the positions in the markets from the commercials that are actually utilizing futures as a hedging protocol. Let's say, the farmers or the meat industry, the butchers, and then you have the speculators, and then you have the large institutions, and then you have the smaller ones. So you have large and smaller speculators that are there for profit. And you'll get an idea that, okay, if the majority of people are long, then you should probably look to buy. If the big players are selling, then you should probably look to sell. So you see the commitment of traders by seeing how large their positions are. And a lot of people swear by this. And when I brought this up to Larry Williams, and also brought this up to Jason Shapiro, first of all, who was a big proponent of this, he said, yes, I use it, but I use it in a different way to everyone else. I was like, what does that mean? He's like, when everybody is buying in the COT reports, and COT report is at the high, meaning 90%, 95% of people are buying, institutions, hedge funds, pension funds, when they are buying, he will sell. And I was like, that doesn't make sense. Why would you do that? Because, I thought it's a self-fulfilling prophecy. That's what other traders have told me. If the big players are buying with trillions or billions of dollars, then the market must go up, because they're not going to ladder in all of this money and have geopolitical outlooks and macroeconomics and fundamental analysis and be wrong. And he said, yes, most institutions, most funds are trend trading. In fact, I was at the CTA Expo in Chicago, where I was at an event designed for fund allocators meeting hedge fund traders. And it's a cool environment, because you're seeing people basically pitching themselves to get investment despite their track record, because everyone had a good track record. So then it became, what kind of a trader are you? Are you a trend follower? Are you a systematic? Are you a quant? And all of them have good track records. And it was very interesting to see how these guys interact. And one piece of information they all spoke about was the non-correlation to the S&P. Basically saying, like, do you really beat the market, or are you just putting it in the market? Anyway, the point here is that Jason Shapiro has built a career, Larry Williams has built a career of trading against the masses. So when he sees, I thought it's a self-fulfilling prophecy, right? If everybody's buying, the market must go up, especially if the big players with the big money are doing that. He said, yes, when the big players get in and price is low, price will go up. And then the trend followers jump in, and then the euphoria traders jump in, and it reaches a point where the market is so high, where 95% of people are long. So if price keeps going up, who's going to be the buyers that continues for it to go up? And I was like, yes. Interesting point. At some point it reaches where everyone that could buy, that has the money to buy, that wanted to buy, has bought. and for price to keep going up, you need more buyers. So he said at that point, when you have 95% plus buyers in the market from the CO2 report, he built it into an oscillator. He said at that point, you just need a catalyst. You need a news event, you need something to switch, and all of these buyers will jump out of the market, sellers will get in, and you really have a drop in price. You have mean reversion, as it's called, but you have asymmetrical gain, and you have it quick with momentum. And I had this whole conversation of, well, why not just trend trade like everyone else? Why not follow the big money? Why be a non-conformist to the big money? His track record stands for itself. Then I spoke yesterday to Larry Williams, 11,000%, and he said a similar thing. He said, I trade against the masses, not just the CO2 report. He was like, I started trading the CO2 report when it first came out, when it used to be sent to me by post and it took weeks to arrive on a piece of paper. And a lot of these guys that have outsized gains, that have stood the test of time, have not been trend traders. They've been mean reversion, meaning they'll find an overextended market, wait for a catalyst, and wait for it to revert back against the masses. Larry Williams' perspective was not just the CO2 report, but also utilizing open positions, which is another report that basically tells you the size and the magnitude of positions, and not just net long and short, but how much interest. Basically shows aggression in the market. So he's kind of doing pairing or divergences for this. And then the quant trader Rishi, we also explored this idea of, because I started to explain my scenario of, I'm trading liquidity, I'm trading retail traps, I'm trading support and resistance liquidity, I'm trading trendline liquidity, smart money liquidity. And I bounced this idea off him because he codes algorithms. And I said, is there any logic in this? He said, yes. He said, crowded nature in the market, crowded being the term where a lot of people are doing the same thing in a predictable way, whether it's the CO2 report, whether it's the Larry Williams perspective, or whether it's the Rishi perspective. All of these algorithms hunt and are aware of where most liquidity is. And it's like, if a lot of people are entering on a support level, it is likely to fail. If a lot of people are entering on a trend line, it's likely to fail. As time has gone on, we see it's happening in smart money concepts. The evidence is there in the market, and I've started to exploit it only in the last few years. But I asked him why. I asked him why, number one, and I asked him number two, why don't the institutions exploit it too, or do they exploit it? He said no. He said institutions are not necessarily scalping or intraday trading with large money. And we had a whole 30-minute discussion on this. And in fact, another favorite episode of mine was with Samir Varma. He is an author, he's a hedge fund manager, and he's a physicist, one of the smartest guys I've ever spoken to. And he was exploring this idea with me, both Rishi and Samir. They said this idea of alpha decay, meaning the moment an edge is found or an inefficiency in the market is found, in exploiting that inefficiency, you create efficiency and the edge disappears. Meaning as you exploit an edge in the market, it will fade over time with large money. And the smaller your edge, the smaller your inefficiency, the quicker it disappears. And the larger money you have, the harder it is to access and enter the market on short time horizons. So they said if an institution would love to scalp, an institution and a hedge fund would love to scalp with tens of billions of dollars on the 1 minute time frame, because of the decay of certainty over time. Something I speak about, which is if someone put a gun to your head and said, where is gold going to be in 10 minutes from now? You would say it's going to be like a little bit higher, a little bit lower, 90% chance, and it will be true. But if someone says, where is it going to be in 5 years from now? It could be really high, really, really high, or low. We just have no certainty of what can happen in years. So when hedge funds and institutions are trading large money and doing over long duration of time, of course they have a disadvantage, and they overcome it with fundamentals and other things. But it is an inherent disadvantage because the information we have today is going to maybe unravel as new things come to light. And that's just how the market is. But I said, why don't they then scalp? He said, because you get alpha decay at large amounts of money. You will get front run if you do large orders. You will not get your orders will not get placed in the market if you're placing these ginormous orders. You will not have the counterparts. If you're looking to buy, you won't have the sellers in place at large volume. So not only will you have an alpha decay, you will have an inability to execute at scale. So when you're managing tens of billions, you can't be trading on the lower time frame, even in a liquid market. And lastly, you will have alpha decay. Costs. They said the costs would be very high, transaction costs, which is why they kind of go towards higher time frame swing trading and position trading and investing, which we would call it. So I felt quite lucky then, because when I elaborated on these concepts with them, They were like, yeah, you're in a good spot. If you're a retail trader trading a large amount of money for a retail trader, but not, the tens of millions, you're not going to run into any problems. You're not going to have liquidity problems. You're not going to have alpha decay in the same way. You're not going to have extortionate costs, and you can trade and make a great living for yourself. And then I asked them, okay, why did they take the hedge fund route and so forth? But the reassuring feeling here is that I've been doing the right thing. And I encourage you to also think in a non-conformist, like I've cited 3-4 phenomenal industry legends, some of the most famous traders in the world with the most phenomenal track records that have beat the markets for decades, are saying be a non-conformist in the markets, because they say everyone is a trend trader. Everyone is a support and resistance trader. Do the opposite. It will serve you at a large scale and a small scale. And this has been powerful. In fact, only in the last 5 years, I've really honed in on this idea of intra-session trading with M1, with liquidity and traps. And it's been like exponential for me. And this thing that I said at the beginning of, as my trading career has gone on, I haven't learned less, I've only learned more. And small things have big impact, because you reach an area where you've the 80-20, you've done the 80, now it's that 20%, and a small change, a 1% adjustment, can have a huge impact. For example, the profit taking systems. I spoke to Samir, who was a data man. He's a physicist, he loves data, and we spoke about how he walks through data in his analysis and backtests in a professional way. And he kind of said that you have to do it manually, but you have to have a huge sample size. And I asked him about profit taking systems and told him about mine. And he smiled and he told me how he does it. And to share with you how I did it, I went through 1,000+ trades, going back years of trades I actually took, and I plotted, where did I take profit? Where did the market go? Meaning to say, how much money did I leave on the table? Sometimes I didn't take a profit in time. Sometimes I took a profit too early. So then I started to map a bell curve where you had the outliers of price went miles away, really, really far, and I took profit too early. That's an anomaly. On the other side, you have another anomaly where price went 2 pips into profit. But the majority was in the middle, and I found my optimal places to take profit based on data, not based on technicals, not based on price action, because that can be a fallacy. And yeah, it's been a phenomenal learning curve, and I'm really proud to share these things with you guys. And what I want to just end this video on as a piece of advice is, if you become a non-conformist in life, money takes care of itself. I've well documented, I made my first $1 million in early 2019. So what is that? 6 years ago. 6 years ago, I made the $1 million. And thankfully, through the grace of God, and I'm very grateful to be in this position, I don't think about money. I've got just this year, I invested several 7 figures into the tariff crash, and I'm up multiple 6 figures by doing nothing passively, just through investments in the stock market. Money boxes ticked, and you reach a point where you want to build, and it's not a case of chasing a goal anymore. It's not a case of chasing money anymore. It's not the pursuit of happiness, it's the happiness in the pursuit. And I really feel like I've embodied that, because I feel so blessed to travel the world and have these kind of experiences and call it work, meet the coolest people, travel the world, build my skill set, build my network, and just have a great time and make a platform out of it and share value to my audience. Now, I'm not saying you have to go be a podcaster. I'm just saying find your path, and your life will be more than the 9-to-5 path that was put in front of you of go to school, go to university, get a good degree, get a good job. I did that. 6 years at university to become a dentist. I carved out my own path. Carve out your same path. The money box will take care of itself with time, because if you're pursuing something with passion that you really enjoy, money is a byproduct. And when that money box is ticked, more money will find you, which is the irony of life. And then you will work from a place of fulfillment where you're chasing the process, not the outcomes. Anyway, that was my little rant. Hope it was of some value. And as I always say, a restricted trader is a profitable trader.